money, power, influence. For over 150 years, one name has been at the center of it all. They've financed empires, crashed markets, survived when giants fell. They've been called geniuses and vampires, heroes and villains. They've placed their people in the highest offices of government and made fortunes from the world's greatest crises. They've bailed out nations and brought governments to their knees. Some say they're the beating heart of capitalism. Others say they're what's wrong with it. This is the story of how a German immigrant with a leather bag full of promissory notes built the most powerful, most controversial, and most resilient financial institution in history. This is the story of Goldman Sachs. Goldman. In 1869, America was a nation transformed by war and standing at the threshold of an industrial revolution. The Civil War had ended just 4 years earlier, leaving the country scarred but hungry for growth. Railroads were stretching across the continent. Factories were rising in northern cities. And in the narrow, crowded streets of Lower Manhattan, a new kind of economy was being born. One built not on land or labor, but on trust, paper, and promises. It was here, in a cramped basement office on Pine Street, that a German Jewish immigrant named Marcus Goldman began a business that would one day become the most powerful investment bank in the world. Marcus Goldman was not born into wealth. He arrived in America in 1848 at the age of 17, fleeing political upheaval in Bavaria. Like so many immigrants of his generation, Goldman carried little more than ambition and a willingness to work. He tried his hand as a shopkeeper in Philadelphia. He peddled goods door to door. But it was in New York, in the years following the Civil War, that Goldman found his calling. Goldman's innovation was deceptively simple. He didn't lend money. He didn't build factories. Instead, he dealt in something far more abstract: commercial paper. Here's how it worked. A small jeweler on the Lower East Side needs cash to buy inventory, but he won't get paid by his customers for months. Marcus Goldman steps in. He buys the jeweler's IOU, his promise to pay, at a discount. Goldman then sells that paper to a bank for a small profit. The jeweler gets immediate cash. The bank gets a safe, short-term investment. And Marcus Goldman? He takes a slim margin in the middle. It was financial alchemy. Goldman was creating liquidity out of trust, turning future promises into present capital. And in a rapidly growing economy starved for credit, this service was invaluable. By the 1870s, Marcus Goldman had become a fixture in New York's financial district. He walked the streets daily, a leather bag tucked under his arm, stuffed with promissory notes from leather merchants, textile dealers, and wholesalers. His reputation was his currency. Banks trusted him because he knew his clients. He vetted them personally. He understood their businesses. In an era before credit scores or electronic records, Goldman's judgment was everything. But Goldman was also shrewd enough to know that his business couldn't remain a one-man operation forever. In 1882, he made a decision that would define the firm's future. He invited his son-in-law, Samuel Sachs, to join him as a partner. Samuel Sachs was everything Marcus Goldman was not. Where Goldman was cautious and methodical, Sachs was ambitious and outward-looking. Where Goldman had built relationships, one merchant at a time, Sachs envisioned something larger, a firm that could bridge the gap between America's growing corporations and the capital markets. Together, they formalized the partnership. The firm was now officially Goldman, Sachs & Co. And with Sachs at the helm of expansion, the firm began to evolve. By the 1890s, Goldman Sachs was no longer just a local broker. The firm was handling millions of dollars in commercial paper annually. It had relationships with dozens of banks, and it was beginning to attract attention from larger corporations looking for more sophisticated financial services. This was the Gilded Age, an era of titanic fortunes and ruthless ambition. John D. Rockefeller was building his oil empire. Andrew Carnegie was forging steel. J.P. Morgan was consolidating railroads, and in this landscape of giants, Goldman Sachs was still a small player. But it was learning, watching, preparing. Marcus Goldman retired in 1894, handing full control to his son-in-law and a new generation of partners. By then, the firm had established something invaluable: a reputation for integrity. In an industry often plagued by speculation and scandal, Goldman Sachs was known for being conservative, reliable, and discreet. But as the 19th century drew to a close, the world of finance was changing. Corporations were growing larger, capital needs were exploding, and a new kind of transaction was emerging, one that would transform Goldman Sachs from a commercial paper dealer into a true investment bank. That transaction was called an initial public offering, and in the opening years of the 20th century, Goldman Sachs would make a bold, risky bet on this new frontier. A bet that would either elevate the firm to the top tier of Wall Street or destroy it. The age of the deal was about to begin. The turn of the century brought with it a new America, one of electricity, automobiles, and industrial might. The nation was no longer a collection of regional economies, but a unified colossus, hungry for capital and innovation. And Wall Street, that narrow canyon of ambition in lower Manhattan, was becoming the engine room of American capitalism. At the top of this pyramid sat the aristocrats of finance: J.P. Morgan, whose word could stabilize markets; Jacob Schiff of Kuhn, Loeb & Co., who financed railroads and governments; the old guard whose handshake deals moved millions. Goldman Sachs, still primarily a commercial paper house, operated in their shadow. But Samuel Sachs had a vision. He understood that the future belonged not to those who merely financed existing businesses, but to those who could create new ones by taking companies public. An initial public offering, an IPO, was financial theater. A private company, owned by a family or small group of investors, would sell shares to the public for the first time. This required underwriting. An investment bank would buy all the shares from the company, then resell them to investors at a markup. If the public didn't buy, the bank was stuck holding worthless paper. It was lucrative, but dangerous. In 1906, Goldman Sachs took the plunge. Samuel Sachs partnered with Lehman Brothers, another firm with German-Jewish roots, to underwrite their first major IPO, the United Cigar Manufacturers Company. It was a gamble. United Cigar was large, but untested in the public markets. If the offering failed, Goldman's reputation and its capital would evaporate. Samuel Sachs paced his office the night before the sale, chain-smoking, reviewing numbers, questioning everything. The offering was a triumph. Shares sold out within hours. Investors clamored for more, and Goldman Sachs had proven it could play in the big leagues. Over the next 2 decades, Goldman Sachs became one of Wall Street's premier underwriters. They took Sears, Roebuck & Company public in 1906, a deal that transformed a mail-order catalog into a retail empire. They underwrote Woolworth's 5 and dime stores. They brought tire manufacturers, department stores, and industrial firms to market. Goldman Sachs was no longer the scrappy immigrant's basement operation. It was a Wall Street institution. But success bred ambition, and ambition, unchecked, breeds disaster. In 1918, Goldman Sachs hired a man named Waddell Ketchings. Ketchings was everything the old guard was not: brash, charismatic, a master of persuasion. He had worked at J.P. Morgan and came to Goldman with grand plans. He convinced the partners to move beyond underwriting and into something far more speculative: investment trusts. An investment trust was essentially a mutual fund, but with a twist. The trust would raise money from the public, then use that money to buy stocks. Investors loved them because they promised instant diversification and professional management. But here's the catch: trusts could use leverage. They could borrow money to buy more stocks, and they could invest in other trusts. It was a house of cards waiting for a strong wind. In December 1928, Goldman Sachs launched the Goldman Sachs Trading Corporation. It raised over $100 million almost overnight, a staggering sum. The public couldn't buy shares fast enough. Catchings was hailed as a genius. The trust's stock price soared. And then came the mania. The Goldman Sachs Trading Corporation began buying shares in other trusts. Those trusts bought shares in still more trusts. The firm launched a second trust, the Shenandoah Corporation, then a third, the Blue Ridge Corporation. Each one more leveraged than the last. Each one built on the inflated value of the one before. By the summer of 1929, the Goldman Sachs Trading Corporation stock was trading at more than double its initial price. Waddell Catchings was a hero. Goldman Sachs was printing money. But on Wall Street, euphoria is always followed by a reckoning. On October 24th, 1929, Black Thursday, the bubble burst. Panic selling swept through Wall Street. By Tuesday, October 29th, the market was in free fall. In a single day, billions of dollars in wealth vanished. And the Goldman Sachs Trading Corporation? It collapsed spectacularly. Shares that had sold for $104 in 1929 were worth less than $2 by 1932. Investors, many of them ordinary Americans who had trusted the Goldman Sachs name, lost everything. The trust had become a symbol of Wall Street greed and recklessness. In 1932, a lawyer named Ferdinand Pecora led a Senate investigation into the causes of the crash. Waddell Catchings was called to testify. Under oath, the full scope of the disaster became clear. The trusts had been, in Pecora's words, a colossal scheme that enriched insiders while devastating public investors. The damage to Goldman Sachs was catastrophic, not financially, but reputationally. The firm survived, but it was no longer trusted. Clients disappeared. Deals dried up. The name Goldman Sachs, once synonymous with integrity, was now tainted with scandal. The 1930s were a wilderness for the firm. The Glass-Steagall Act of 1933 separated commercial and investment banking, reshaping the entire industry. The Securities Act imposed new regulations, and Goldman Sachs, humbled and diminished, retreated into the shadows. But in the depths of this crisis, a new leader emerged. His name was Sidney Weinberg, and he would spend the next 3 decades rebuilding Goldman Sachs from the ruins. Weinberg had started at Goldman as a janitor's assistant in 1907 at the age of 16. He swept floors, polished brass, and dreamed of something more. Through sheer intelligence and work ethic, he climbed the ranks, from porter to clerk to trader to partner. Now, in the firm's darkest hour, he became its de facto leader. Weinberg's strategy was simple: rebuild trust, one relationship at a time. He took no shortcuts. He courted corporate clients with patience and humility. He advised CEOs not with flashy promises, but with sound judgment. Slowly, painfully, Goldman Sachs began to claw its way back. And then, in 1941, everything changed. America entered World War II. The economy mobilized for war, and Goldman Sachs, having survived its greatest scandal, was about to enter a new era. one that would transform it from a disgraced Wall Street firm into an indispensable advisor to corporate America. The age of the trusted advisor had begun. August 14, 1945. Victory over Japan. The war was over, and America stood alone as the world's undisputed economic superpower. Europe lay in ruins. Asia was shattered. But the United States, its factories humming, its workforce trained, its currency strong, was poised for an explosion of growth unlike anything in human history. In the decades that followed, American corporations would grow into global giants. General Electric, General Motors, IBM, DuPont. And behind many of these titans, quietly advising, strategizing, and orchestrating, was a man in thick glasses with a Brooklyn accent, Sidney Weinberg of Goldman Sachs. Sidney Weinberg was not a typical Wall Street banker. He didn't come from money. He didn't attend Harvard or Yale. He grew up in a tenement in Brooklyn, the son of Polish immigrants. His father was a bootlegger and a liquor wholesaler. Sidney left school after 8th grade to help support his family. He arrived at Goldman Sachs in 1907 as a janitor's assistant, earning $3 a week. He swept floors. He cleaned spittoons. But he also watched. He listened. And he learned. By the 1930s, Weinberg had become a partner. By the 1940s, as the old guard retired or died, he became the firm's senior partner and de facto leader. He inherited a firm still scarred by the trading corporation scandal, still mistrusted by clients, still struggling for relevance. Weinberg's genius was not in financial engineering or aggressive deal-making. It was in relationships. He believed that Goldman Sachs should be more than just a transaction machine. It should be a trusted advisor, the kind of firm a CEO would call, not just when he needed to raise money, but when he needed counsel on strategy, succession, or crisis management. Weinberg kept meticulous notes on every client. He remembered birthdays. He knew the names of their children. He understood their businesses better than their own board members. And he never, ever oversold. If a deal was bad for the client, Weinberg said so, even if it meant losing a fee. In 1956, Weinberg orchestrated what was then the largest stock offering in history, the initial public offering of the Ford Motor Company. For nearly 50 years, Ford had been privately held by the Ford family. But after Henry Ford's death, the family needed liquidity, and the company needed capital. It was a monumental undertaking. The deal required coordinating dozens of underwriters, navigating complex tax issues, and managing the expectations of the notoriously difficult Ford family. But Weinberg pulled it off. The offering raised over $600 million, a staggering sum, and it established Goldman Sachs as a premier advisor for the most important corporate transactions in America. Through the 1950s and 60s, Weinberg repeated this formula again and again. He advised on mergers. He structured buyouts. He became a board member on over 30 major corporations, including General Electric, General Foods, and Continental Can. He was so well connected that he earned the nickname Mr. Wall Street. But Weinberg also understood that Goldman Sachs couldn't rely on one man forever. The firm needed to institutionalize its culture, to build systems, processes, and teams that could outlast any single individual. In the 1950s and 60s, Goldman began to modernize. The firm hired aggressively, not just Ivy League bankers, but also mathematicians, economists, and analysts. It created specialized departments, mergers and acquisitions, equity research, fixed income trading. It opened offices beyond New York, in Chicago, Los Angeles, and eventually London. And Weinberg brought in a man named Gus Levy to build Goldman's trading operation. Gus Levy was Weinberg's opposite in almost every way. Where Weinberg was patient and relationship-focused, Levy was aggressive and numbers-driven. He had started as a trader in the 1930s and had an almost supernatural ability to read markets. He could see opportunities others missed. He could move fast and strike hard. Under Levy's leadership, Goldman Sachs pioneered a new business called block trading. Here's how it worked. A large institutional investor, a pension fund or insurance company, wants to sell a massive block of stock, say 1 million shares. If they dump it on the open market, the price will crash. So Goldman steps in. The firm buys the entire block at a discount, then resells it in smaller pieces to other investors. Goldman takes the risk and the profit. It required capital, courage, and split-second decision-making. And Gus Levy was a master. By the late 1960s, Goldman Sachs was one of the top block trading firms on Wall Street. The firm was no longer just an advisor. It was a principal, a risk taker, a market maker. Weinberg and Levy represented two sides of Goldman Sachs: the trusted advisor and the aggressive trader, the relationship banker and the risk taker. Together, they transformed the firm into something larger and more powerful than either could have built alone. But as the 1960s gave way to the 1970s, the world was changing in ways that would test Goldman Sachs once again. The post-war boom was ending. Inflation was rising. The Bretton Woods system, which had stabilized global currencies since 1944, collapsed in 1971. Oil shocks in 1973 and 1979 sent energy prices soaring. America entered a period of stagflation, stagnant growth combined with high inflation that defied traditional economic theory. For Wall Street, the 1970s were brutal. Stock prices stagnated. Trading volumes collapsed. Many firms struggled to survive. Several went under. And in 1969, Sidney Weinberg died. His death marked the end of an era. Weinberg had led Goldman Sachs for nearly 40 years, through depression, war, scandal, and rebirth. He had transformed it from a disgraced underwriter into one of the most respected names in finance. Gus Levy took over as senior partner. But Levy faced challenges Weinberg never had. The old model: relationship banking, patient advice, gentlemen's agreements, was being disrupted by a new breed of aggressive, transaction-driven firms. Competition was intensifying. Clients were demanding more. And a new financial instrument was emerging that would revolutionize Wall Street: the leveraged buyout. Leveraged buyouts, LBOs, used borrowed money to buy entire companies, then restructured them for profit. It was aggressive, lucrative, and risky. And it was about to unleash a wave of deal-making that would dwarf everything that came before. In 1976, Gus Levy died suddenly of a stroke. Two men stepped up to lead the firm: John Whitehead and John Weinberg, Sidney's son. They would guide Goldman Sachs into the most explosive era in Wall Street history. The 1980s were coming, and with them, a gold rush unlike anything finance had ever seen. The age of the mega deal was about to begin. January 20th, 1981. Ronald Reagan raised his hand and took the oath of office as the 40th President of the United States. His message was clear: government was the problem, not the solution. Regulations would be dismantled, taxes would be cut, markets would be unleashed. It was the beginning of a revolution, not just in politics, but in finance. The 1980s would witness an explosion of deal-making, risk-taking, and wealth accumulation, unlike anything in American history. And at the center of it all was Goldman Sachs. Under the leadership of John Whitehead and John Weinberg, Goldman Sachs entered the 1980s with a clear strategy: dominate mergers and acquisitions, expand globally, and build the most talented team on Wall Street. Whitehead and Weinberg made an unlikely pair. Whitehead was the strategist, the thinker who wrote down Goldman's business principles and shaped its culture. Weinberg was the deal maker, the bulldog who won clients through force of personality. Together, they formed a partnership that would define the firm for 2 decades. Whitehead codified what became known as the Goldman Sachs business principles, 14 rules that emphasized client service, integrity, and teamwork. Principle number 1, our clients' interests always come first. These weren't just words on paper. They were drilled into every new hire, repeated in every meeting, and used to justify every major decision. Or so the firm claimed. The 1980s unleashed a tidal wave of corporate takeovers. Deregulation made it easier to buy and sell companies. Junk bonds, high risk, high yield debt, made it possible to finance massive acquisitions with borrowed money. And a new generation of corporate raiders, men like Carl Icahn, T. Boone Pickens, and Henry Kravis, turned hostile takeovers into an art form. Here's how it worked. A raider identifies an undervalued company, buys up shares quietly, then launches a hostile bid to take control. Management fights back, sometimes by finding a white knight, a friendlier buyer, or by implementing poison pills and other defenses. Either way, investment banks make fortunes advising both sides. Goldman Sachs positioned itself as the defender of corporate America, the firm that management called when raiders came knocking. In 1985, when corporate raider Ronald Perelman launched a hostile bid for Revlon, Goldman advised the target company. The battle was brutal, playing out in courtrooms and boardrooms for weeks. Perelman ultimately won, but Goldman earned millions in fees and cemented its reputation as a fierce defender. Then came the deal of the decade. In 1988, RJR Nabisco, the food and tobacco conglomerate, became the target of the largest leveraged buyout in history. The battle-pitted management, led by CEO Ross Johnson, against private equity titan Henry Kravis of KKR. Investment banks circled like sharks, each vying for a piece of the action. Goldman Sachs initially advised the management team, but when the deal became too aggressive, too risky, the firm made a controversial decision. It withdrew. Goldman's leaders believed the terms violated their principles. The deal, they felt, was bad for shareholders and bad for the firm's reputation. It was a moment that defined Goldman's culture, or at least the culture it wanted to project. While other firms chased fees at any cost, Goldman claimed to prioritize principles over profit. KKR won the bidding war with a $25 billion offer. Goldman walked away. Some called it integrity, others called it a miscalculation. But the message was clear. Goldman Sachs was different. But Goldman wasn't just winning deals in America. The firm was going global. Throughout the 1980s, Goldman opened offices across Europe and Asia. The firm advised on privatizations in the United Kingdom, where Margaret Thatcher was selling off state-owned enterprises. It expanded into Japan, forming relationships with the powerful keiretsu, industrial conglomerates. It entered emerging markets in Latin America and Southeast Asia. And when the Berlin Wall fell in 1989, Goldman was among the first Western banks to establish a presence in Eastern Europe, betting on the transformation of former communist economies. By the early 1990s, Goldman Sachs was no longer just an investment bank. It was a diversified financial powerhouse. The firm had built one of the most sophisticated trading operations in the world. It managed billions in client assets. It traded currencies, commodities, and derivatives. and it was printing money. But this expansion came with a cultural shift. The old Goldman, Sidney Weinberg's firm of patient advisors and gentlemanly bankers, was giving way to a new breed: aggressive traders, quantitative analysts, and rainmakers motivated less by relationships than by bonuses. Wall Street in the 1990s was a meritocracy of money. If you made the firm rich, you got rich. Goldman's compensation structure was ruthlessly competitive. Partners could earn tens of millions annually. Even junior bankers could make more in a year than most Americans earned in a lifetime. But there was a cost. The pressure was immense. The hours were brutal. 100-hour weeks were common. Burnout was rampant. And the culture, for all its talk of teamwork, was cutthroat. In 1990, John Whitehead and John Weinberg stepped down. Stephen Friedman and Robert Rubin took over as co-senior partners. Both were brilliant, both were ambitious, and both believed Goldman needed to take an even bigger leap, becoming a public company. Since its founding, Goldman Sachs had been a private partnership. The partners owned the firm, they shared the profits, and they bore all the risks. If Goldman failed, they lost everything. This structure created alignment. Partners thought long-term because their personal wealth was on the line, but it also limited growth. As a partnership, Goldman could only raise capital from its partners. To compete with larger, publicly traded rivals, the firm needed access to public markets. The debate was fierce. Old guard partners resisted. Going public meant giving up control, sharing ownership with outsiders, and potentially compromising the culture. But younger partners saw the opportunity: access to billions in capital, the ability to make massive acquisitions, and personal wealth that could be measured in hundreds of millions. In 1998, the partners voted. Goldman Sachs would go public. On May 4, 1999, Goldman Sachs held its initial public offering. The firm sold shares at $53 each, raising $3.7 billion overnight. The partners became billionaires. The firm's market value was $33 billion. It was one of the most anticipated IPOs in Wall Street history, and it marked a fundamental transformation. Goldman Sachs was no longer a partnership, accountable only to itself. It was now a public corporation, answerable to shareholders, regulators, and the market. The man leading Goldman into this new era was Henry "Hank" Paulson, a former Dartmouth football player and Harvard Business School graduate. Paulson had joined Goldman in 1974 and risen through the ranks by sheer force of will. He became CEO in 1999, just as the firm went public. Paulson took the helm at the peak of the dot-com bubble. Technology stocks were soaring. Goldman was underwriting IPO after IPO for internet startups, companies with no profits, sometimes no revenue, but sky-high valuations. Then, in March 2000, the bubble burst. The NASDAQ crashed. Trillions in wealth evaporated. Dozens of Goldman's tech clients went bankrupt. But Goldman survived, largely unscathed. The firm had hedged its bets, diversified its revenue, and avoided the worst excesses. While competitors struggled, Goldman reported record profits. And then came September 11, 2001. Goldman's offices were just blocks from the World Trade Center. When the towers fell, the firm's headquarters were engulfed in smoke and debris. Miraculously, no Goldman employees died in the attacks. But the city and the financial industry was shattered. In the weeks that followed, Wall Street reopened. Goldman Sachs, along with the rest of the financial sector, went back to work. The message was clear: America and American capitalism would not be defeated. By the mid-2000s, the economy was roaring again, but this time, the boom was built on something different. Real estate, Housing prices were skyrocketing. Banks were lending to anyone with a pulse. And Wall Street was packaging those loans into complex securities and selling them around the world. It was called securitization, and Goldman Sachs was one of its masters. But beneath the surface, something was deeply wrong. The entire system was built on a foundation of sand. And when the tide went out, the world would discover just how reckless and how interconnected the financial system had become. The greatest financial crisis since the Great Depression was about to begin, and Goldman Sachs would be at the very center of it. By 2006, the American housing market had become a fever dream. Prices had doubled in just 5 years. Construction was booming. Millions of Americans were taking out mortgages they couldn't afford, convinced that home values would rise forever. On Wall Street, the money was flowing like never before. Banks were lending to anyone: undocumented immigrants, unemployed workers. People earning $30,000 a year were buying $500,000 homes. The loans were called subprime, meaning they were made to borrowers with poor credit. But the risk didn't stay with the banks. Here's how the machine worked. A bank makes 1,000 subprime mortgages. Instead of holding them, it bundles them together into a security, a mortgage-backed security, or MBS. This security is then sliced into pieces called tranches, each with different levels of risk and return. The top tranches get paid first and are rated AM, supposedly as safe as treasury bonds. The bottom tranches get paid last and absorb the first losses. Wall Street sold these securities to investors around the world: German banks, Chinese sovereign wealth funds, pension funds in Florida. Everyone wanted in. The returns looked great, and the credit rating agencies, Moody's, Standard & Poor's, stamped them with A ratings, blessing them as virtually risk-free. Goldman Sachs was deep in this business. The firm underwrote billions of dollars in mortgage-backed securities. It created complex instruments called collateralized debt obligations, CDOs, which packaged the riskiest tranches of MBS into new securities, effectively laundering risk through financial alchemy. In 2006, Hank Paulson left Goldman to become U.S. Treasury Secretary. His replacement was Lloyd Blankfein, a former commodities trader from Brooklyn who had climbed to the top through Goldman's trading division. Blankfein was smart, aggressive, and ruthlessly focused on profit. By late 2006, some traders inside Goldman began to worry. They were seeing delinquencies rise. Borrowers were defaulting faster than expected. The data didn't lie. The housing market was deteriorating. A group of Goldman traders, led by Josh Birnbaum and Michael Swenson, began analyzing the data. Their conclusion was stark. The subprime market was going to collapse, and when it did, the entire financial system would be at risk. Goldman made a fateful decision. While continuing to sell mortgage securities to clients, the firm began betting against the very products it was creating. Goldman bought credit default swaps, essentially insurance policies that would pay out if mortgages defaulted. The firm was hedging its exposure, but critics would later call it something else: fraud. In early 2007, the housing market cracked. Prices started falling, foreclosures spiked. Subprime lenders began collapsing. First small companies like New Century Financial, then larger players. In June 2007, two Bear Stearns hedge funds, heavily invested in subprime mortgages, collapsed, losing $1.6 billion. It was a warning shot. But Wall Street didn't panic. Not yet. Then the credit markets seized up. Banks, suddenly terrified of losses, stopped lending to each other. The entire system, which depended on constant flows of short-term credit, began to freeze. The Federal Reserve, led by Chairman Ben Bernanke, began emergency interventions, cutting interest rates, injecting liquidity into the banking system. But it wasn't enough. The contagion was spreading. In Britain, Northern Rock, a major mortgage lender, suffered the first bank run in 150 years. The panic was going global. As 2008 began, the financial system was teetering. Major banks had billions in toxic mortgage assets on their books. No one knew who was solvent and who was bankrupt. Trust, the invisible glue that holds finance together, was evaporating. On March 14, 2008, Bear Stearns, one of Wall Street's most storied firms, was on the brink of collapse. The fifth largest investment bank in America was running out of cash. In a chaotic weekend, the Federal Reserve brokered a fire sale to J.P. Morgan Chase. Bear Stearns, once worth $20 billion, sold for $236 million. Wall Street was stunned. If Bear Stearns could fall, anyone could fall. Goldman Sachs, meanwhile, was in a different position. The firm had reduced its mortgage exposure earlier than competitors. It had hedged aggressively, and it had raised capital proactively. Goldman was wounded, but not fatally. But Lehman Brothers, Bear Stearns' larger rival, was in mortal danger. Lehman had $60 billion in commercial real estate and mortgage assets that were rapidly losing value. The firm was drowning in toxic debt. Throughout the summer, Treasury Secretary Hank Paulson, Goldman's former CEO, worked frantically to find a buyer for Lehman. He called foreign banks. He pressured U.S. competitors. He begged private equity firms to step in. On the weekend of September 13th, Paulson gathered Wall Street's top executives at the New York Federal Reserve. The message was clear. The government would not bail out Lehman. The private sector had to find a solution. Lloyd Blankfein was in that room. So were the CEOs of J.P. Morgan, Citigroup, Bank of America, and Morgan Stanley. They discussed rescue plans. They ran numbers. But no one wanted to catch a falling knife. Lehman had too much bad debt. The losses were too large. On Monday, September 15, 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy in American history. $600 billion in assets. Gone. The markets went into free fall. Credit markets froze completely. Banks stopped lending. Companies couldn't access cash. The entire global financial system was on the edge of total collapse. And that same day, another giant was falling. AIG, the American International Group, one of the world's largest insurance companies. AIG had sold hundreds of billions of dollars in credit default swaps, insurance policies on mortgage securities. When those mortgages went bad, AIG owed enormous payouts. But the company didn't have the money. It was essentially bankrupt. The next day, the Federal Reserve made a stunning decision. It would bail out AIG with $85 billion in emergency loans. The government now owned 80% of the company. Here's where the story gets controversial. Goldman Sachs had enormous exposure to AIG, roughly $20 billion in credit default swaps and other derivatives. If AIG collapsed, Goldman would face massive losses. Critics immediately cried foul. The Treasury Secretary was Hank Paulson, Goldman's former CEO. He had orchestrated a bailout that directly benefited his former firm. Goldman received $12.9 billion from the AIG bailout, paid at 100 cents on the dollar. No haircut, no negotiation. Was it corruption? A conflict of interest? Or was it simply pragmatic crisis management? The debate would rage for years. Paulson insisted he was saving the financial system, not Goldman Sachs. But the appearance was damning. In the chaotic days after Lehman's collapse, the contagion spread. Morgan Stanley and Goldman Sachs, the last two independent investment banks, were under attack. Their stock prices plummeted. Clients withdrew funds. Short sellers circled like vultures. Goldman's stock fell from $180 to $47 in a matter of weeks. The firm was losing billions. Confidence was evaporating. For the first time since the 1920s, Goldman Sachs faced an existential threat. Lloyd Blankfein made a desperate call to Warren Buffett, the world's most famous investor. Goldman needed capital. It needed credibility. It needed Buffett's seal of approval. On September 23rd, Buffett agreed to invest $5 billion in Goldman, buying preferred shares with a 10% dividend plus warrants to buy more stock. It was a vote of confidence from the most trusted name in investing. Goldman's stock rallied, but the damage was done. On September 21st, Goldman Sachs and Morgan Stanley made a stunning announcement. They would become bank-holding companies, subject to Federal Reserve regulation. The era of the independent investment bank, which had begun in the 1930s with Glass-Steagall, was over. In early October, Congress passed the Troubled Asset Relief Program, TARP, a $700 billion bailout of the financial system. The government would buy toxic assets from banks and inject capital directly into failing institutions. Goldman received $10 billion. Critics howled. Why was Goldman getting taxpayer money when it claimed to be healthy? Blankfein insisted the firm was forced to take the capital to avoid stigmatizing weaker banks. But the public wasn't buying it. By early 2009, the global economy was in free fall. Unemployment soared. GDP contracted at Depression-era rates. Trillions in wealth had been destroyed. Millions of Americans lost their homes, their jobs, their savings. And then in April 2009, Goldman Sachs reported a profit. The firm had not only survived, it had thrived. While competitors failed and the economy burned, Goldman made $3.3 billion in the first quarter alone. Even more galling, Goldman paid out billions in bonuses. The firm's traders and executives, some of whom had helped create the crisis, were getting rich while ordinary Americans suffered. In July 2009, journalist Matt Taibbi published a devastating article in Rolling Stone describing Goldman Sachs as a great vampire squid wrapped around the face of humanity, relentlessly jamming its blood funnel into anything that smells like money. The backlash was ferocious. Goldman became the symbol of everything wrong with Wall Street. Greedy, reckless, politically connected, and untouchable. Lloyd Blankfein was summoned to Congress. Under harsh questioning, he defended Goldman's actions. The firm, he insisted, had acted prudently, had hedged responsibly, and had not caused the crisis. But in April 2010, the Securities and Exchange Commission filed a bombshell lawsuit. Goldman was charged with fraud related to a CDO called Abacus 2007 AC1. Here's what happened. Goldman created a CDO filled with risky mortgages. A hedge fund manager named John Paulson secretly helped select which mortgages to include, specifically choosing the worst ones, because he was betting against the CDO. Goldman sold the CDO to investors without disclosing Paulson's role. When the mortgages failed, Paulson made $1 billion. Goldman's clients lost nearly that much. Goldman settled the case for $550 million. At the time, the largest penalty ever paid by a Wall Street firm. The company admitted to mistakes, but not fraud. But the damage to Goldman's reputation was immense. In July 2010, President Obama signed the Dodd-Frank Act, the most sweeping financial reform since the Great Depression. Banks would face stricter capital requirements. Trading would be limited. Consumer protections would be enhanced. The Volcker Rule, part of Dodd-Frank, banned banks from proprietary trading, betting their own money in the markets. Goldman's legendary trading culture, which had generated billions, was suddenly illegal. By the end of 2010, the immediate crisis had passed. The economy was recovering. The financial system was stabilized. And Goldman Sachs, battered, vilified, but unbroken, had survived. The firm had repaid its TARP funds with interest. It had raised capital. It had posted record profits. But it had lost something intangible and invaluable: its reputation. In the fall of 2011, the Occupy Wall Street movement erupted. Protesters camped in Manhattan's Zuccotti Park, denouncing corporate greed and economic inequality. Their slogan, "We are the 99%, was a direct rebuke to the financial elite. Goldman Sachs became ground zero for their rage. The firm represented everything they opposed: wealth without accountability, power without ethics, profit without conscience. Lloyd Blankfein, once confident and aggressive, seemed chastened. In interviews, he spoke of Goldman's commitment to reform, to serving clients, to rebuilding trust. But the public wasn't listening. Still, Goldman was adapting. The firm was shifting away from risky trading and toward steadier businesses: asset management, wealth management, and technology investment. Wall Street was changing, and Goldman was determined to stay on top. The 2008 financial crisis was the defining moment of a generation. It destroyed lives, shattered economies, and exposed the fragility of a system built on debt, greed, and blind faith in market efficiency. Goldman Sachs emerged from the wreckage, scarred but intact, richer, more powerful, and more controversial than ever. The firm had survived its greatest test. But the questions lingered. Had Goldman learned anything? Had Wall Street changed? Or was it only a matter of time before the next crisis? The story was far from over. In the aftermath of the great financial crisis, America faced a choice: fundamentally reform Wall Street, or allow it to rebuild itself in its own image. The banks had been bailed out. The economy had been saved from total collapse. But millions of ordinary Americans had lost everything: their homes, their savings, their faith in the system. 9 million jobs disappeared. 8 million homes were foreclosed. The crisis had cost the global economy an estimated $22 trillion. It was the worst economic disaster since the Great Depression. And at the center of the public's rage stood Goldman Sachs, a firm that had profited from the crisis, received taxpayer bailouts, and emerged more powerful than ever. Lloyd Blankfein understood that Goldman faced a crisis of legitimacy. The firm needed to rebuild its reputation, redefine its purpose, and prove it could serve society, not just itself. In a 2009 interview, Blankfein made a comment that would haunt him for years. When asked about Goldman's role, he said the firm was doing God's work. The backlash was immediate and brutal. God's work? While families were losing their homes? While unemployment hit double digits? The comment seemed to epitomize Wall Street's tone-deaf arrogance. Blankfein later said he was joking, trying to deflect a hostile question. But the damage was done. Goldman Sachs had become the most hated company in America. Behind the scenes, Goldman was changing. The firm created new risk management systems. It enhanced compliance procedures. It hired thousands of employees just to manage regulatory requirements under Dodd-Frank. The Volcker Rule, which banned proprietary trading, forced Goldman to shut down its legendary Principal Strategies Group, where some of the firm's most profitable traders had operated. Billions in potential revenue disappeared overnight. Gary Cohn, Goldman's president and COO, led the restructuring. The firm would have to find new sources of profit. And Cohn had a vision: technology, emerging markets, and wealth management. Goldman began a strategic pivot toward technology. The firm had historically been skeptical of Silicon Valley. Tech companies didn't need much capital. didn't fit the traditional Wall Street model. But Cohn recognized that technology was reshaping the global economy. Goldman started investing in tech startups through its private equity arm. The firm advised on megadeals: Facebook's $16 billion IPO in 2012, Alibaba's record-breaking $25 billion IPO in 2014, Uber, Spotify, Airbnb. Goldman was positioning itself as the bridge between Silicon Valley and Wall Street. Then came 2016. Donald Trump's election as president brought another Goldman alumni into government. Gary Cohn became director of the National Economic Council, one of the most powerful economic policy positions in America. It was the latest chapter in what critics called Government Sachs, the revolving door between Goldman and high government office. Robert Rubin had been Treasury Secretary under Clinton, Hank Paulson under Bush, now Cohn under Trump. Steve Mnuchin, Trump's Treasury Secretary, was also a Goldman veteran. To critics, this was proof that Goldman had captured the government, that the firm's influence was so pervasive, so deeply embedded, that true reform was impossible. To defenders, it simply showed that Goldman hired talented people who understood finance and were qualified for public service. The debate revealed a deeper truth. Goldman Sachs had become too big to ignore, too connected to fail, and too powerful to effectively regulate. In 2018, Lloyd Blankfein announced his retirement after 12 tumultuous years as CEO. His replacement was David Solomon, a former investment banker who also happened to be an electronic dance music DJ under the name DJ D. Saul. Solomon represented a new generation of Goldman leadership, polished, media savvy, and committed to modernizing the firm's image. He talked about technology, innovation, and culture change. He live-streamed a DJ set from the Hamptons during the pandemic. He appeared on podcasts and social media. Under Solomon, Goldman launched initiatives to address its notoriously brutal work culture. The firm implemented protected Saturdays, encouraging junior bankers to take at least one Saturday off per month. It created mental health resources. It pledged to increase diversity. Historically, Goldman's senior ranks had been dominated by white men. Then came 2020 and another crisis. The COVID-19 pandemic shut down the global economy. Markets crashed, unemployment exploded overnight. But this time, the response was swift and massive. The Federal Reserve and Treasury injected trillions into the financial system. Interest rates went to zero. Money flooded Wall Street. And once again, Goldman Sachs thrived. In 2020, Goldman reported record trading revenues, $17.7 billion, up 43% from the prior year. While small businesses closed and millions lost their jobs, Goldman's traders made fortunes betting on volatility. The inequality was staggering. The disconnect between Wall Street and Main Street had never been wider. But Goldman was also facing new scandals. In 2020, the firm paid $2.9 billion to settle charges related to the 1MDB scandal, one of the largest corruption cases in history. Here's what happened. Between 2009 and 2014, Goldman helped raise $6.5 billion for 1MDB, Malaysia's sovereign development fund. The money was supposed to fund economic development. Instead, billions were stolen by corrupt officials and a flamboyant financier named Joe Lowe. The stolen money funded a Hollywood production company, luxury real estate, fine art, and wild parties. Goldman's own Southeast Asia chairman, Tim Leissner, pleaded guilty to bribery and money laundering. The firm had ignored red flags, bypassed compliance procedures, and prioritized fees over integrity. The scandal devastated Malaysia's economy and toppled a government. Goldman's $2.9 billion settlement was one of the largest corporate penalties in history. But critics noted that the firm had earned $600 million in fees from the deals and had made billions more over the years from its Malaysia relationships. Once again, Goldman had profited from wrongdoing, paid a fine, and moved on. Then came Archegos. In March 2021, a family office run by former hedge fund manager Bill Huang collapsed spectacularly. Huang had used massive leverage to bet on stocks, and when his bets went bad, banks that had lent him money faced catastrophic losses. Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion. But Goldman lost almost nothing. The firm had assessed the risk, demanded more collateral, and when Huang couldn't pay, Goldman aggressively sold his positions before other banks even realized the danger. It was vintage Goldman, ruthless, fast, and willing to act decisively, even if it meant pushing losses onto others. The firm's risk management had once again saved it from disaster, but it also reinforced Goldman's reputation. The smartest guys in the room, always a step ahead, always willing to save themselves first. Today, Goldman Sachs is a $140 billion institution with 45,000 employees in offices around the world. It's no longer primarily an investment bank. Asset management now generates more revenue than traditional banking. The firm manages over $2.5 trillion in assets. Goldman has diversified into new areas: transaction banking, credit cards, through partnerships with Apple and GM, even building its own financial technology platform. The firm is trying to become more than a Wall Street bank. It wants to be a technology company that happens to do finance. The firm has made progress on diversity. Women now make up 36% of Goldman's workforce and 29% of its leadership. Still far from parity, but better than a decade ago. The first black partner joined in 1988. Today, there are dozens. Goldman has committed to deploying $750 billion in sustainable finance by 2030. It's pledged net zero emissions. It's launched initiatives on racial equity and economic opportunity. Are these genuine commitments or just public relations? Goldman's critics remain skeptical. The firm's culture, they argue, hasn't fundamentally changed. It's still obsessed with profit, still aggressive, still willing to push ethical boundaries, and Goldman's influence remains enormous. Its alumni run central banks, lead Fortune 500 companies, advise presidents and prime ministers. The firm's tentacles reach into every corner of global finance. But Goldman isn't invincible. Marcus, the consumer banking experiment, largely failed. The firm lost billions trying to compete with retail banks. In 2023, Goldman announced it would scale back Marcus dramatically. Serving ordinary consumers, it turned out, was harder than the firm thought. David Solomon has faced criticism from investors and even from within Goldman. The firm's stock has underperformed competitors. Some question whether Solomon's DJ hobby is appropriate for a CEO. Others wonder if Goldman has lost its edge. Goldman faces new challenges in a rapidly changing world. Artificial intelligence is automating jobs that used to require armies of analysts. Cryptocurrency and decentralized finance threaten to disrupt traditional banking. Climate change poses existential risks to the global economy. And cultural attitudes are shifting. Younger generations are more skeptical of Wall Street, more demanding of corporate responsibility, less impressed by pure profit maximization. So what is Goldman Sachs' legacy? The firm that began in a basement office in 1869 has become one of the most powerful institutions in global finance. It has survived panics, depressions, scandals, and crises that destroyed its competitors. It has made and lost fortunes. It has shaped markets, influenced governments, and transformed industries. Goldman represents both the best and worst of capitalism. At its best, the firm is innovative, excellent, and essential, allocating capital efficiently, advising on transformative deals, solving complex financial problems. At its worst, it's greedy, reckless, and corrosive, prioritizing profit over principle, privatizing gains while socializing losses, corrupting the political system through its influence. The fundamental question remains: has Goldman Sachs served society or only itself? The firm would argue it has done both. That by succeeding, by being profitable, by advising companies and governments, it has created jobs, generated wealth, and strengthened economies. That its success is proof of its value. Critics would counter that Goldman has extracted far more value than it has created, that the firm has profited from crises it helped cause, that it has used political connections to avoid accountability, that it has widened inequality and destabilized the economy in pursuit of profit. The truth, as always, is complicated. Goldman Sachs is neither purely heroic nor purely villainous. It is a product of its environment, a firm that has thrived under capitalism's rules, maximizing shareholder value and partner wealth within, and sometimes beyond, the boundaries of law and ethics. Goldman didn't create the system, but it has mastered it better than almost anyone else. 155 years after Marcus Goldman began trading promissory notes from a basement, his firm stands as a monument to ambition, intelligence, and the pursuit of power through finance. Goldman Sachs has survived every crisis. It has outlasted every competitor, and it shows no signs of slowing down. The question now is what comes next? Can Goldman adapt to a world demanding more than just profit? Can it balance shareholder value with social responsibility? Can it be a force for good, or will it remain a symbol of everything wrong with modern capitalism? Only time will tell. But one thing is certain: Goldman Sachs will be there, at the center of global finance, doing what it has always done, surviving, adapting, and above all else, winning. For better or worse, the story of Goldman Sachs is the story of American capitalism itself.